Hi there, my name is Tone Tai, and today I will be giving you a product presentation from WFG, talking to you about one of our products. It's called FFIUL. But before I start with this product, I want to give you some financial education. Okay, the first thing is let's talk about taxes. There are three types of taxes, three buckets of taxes, right? The first one is things that are taxable. Right? Things that are taxable is basically things like real estate, investment. Anytime you buy and sell properties, you have to pay taxes. Anytime you sell stocks, right? Stocks and bonds, you have to pay taxes. And lastly, things like your savings account. When you earn interest at the end of the year, you're gonna get a 1099 from your bank. Basically, you gotta pay taxes. And the second thing is tax deferred, right? This is basically you get taxed later. People who work for a corporation or a company, they're familiar with things like 401k, right? You put your money into a type of investment, right? You don't pay any taxes now, but later on, when you are ready to pull out the money, you will get taxed. Second thing is pension. There's not too many pension plans out there, but those who are familiar with pension is very similar, right? You don't get taxed now, but later when you're ready to pull out the money, you will get taxed. And lastly, pension annuities. There are products out there, right, called annuities, very similar to 401k, but it provides you lifetime income and you will have to pay tax on that. And the last bucket is tax-free. Okay, a lot of people don't know that there are investments out there that are tax-free. One of the things that you can invest for your children is something called 529, right? It's a college savings plan. So if you go to your Bank of America or Wells Fargo, you can talk to them about, hey, I want to open a 529 for my kid, right? Basically, this investment is already you already paid the taxes, right, from your income, and then you invest your money into this 529 plan, and whatever investments that it earns, and your kids can use this for college, and it's tax-free from the investments, right? The only problem with 529 is it's only used for college. So if you want to use this money for a car or something like that, you won't be able to. The second thing is Roth IRA. Roth IRA is a program that the government issued for low-income families. What will happen is they will put money into this Roth IRA, right? And the money growth from it, you don't have to pay any taxes. But there's a limitation, right? You can only deposit $5,500 a year, right? And you cannot pull out until you are 59 and a half. And the last thing that people don't know that is tax-free is the cash value in life insurance policy, right? So if you have a life insurance policy out there, right, and if you have cash value, as it grows over time, you notice that you don't get a bill every year, right, on the interest that you gain. Well, just imagine, right, getting tax-free, right, on the interest you gain, and when you do a withdrawal, right, you don't have to pay taxes, right? So today I want to cover things that are tax-free. And let me ask you this, right? If you had to pick these three buckets in terms of investment-wise, which one would you pick, right? Obviously tax-free, right? Because no one wants to pay taxes, or everyone wants to minimize paying taxes. You can't get around, right? So you rather pay taxes up front, and then at the end, when your money makes a lot of money, you don't pay any taxes. Okay, the next financial thing I want to talk about is Rule 72. Right? Rule 72 is basically the law of compound interest. All right? So what that means is you take the percentage of the interest rates you have divided by 72, and that's the amount of years that it would take for your money to double. So I'm just going to give you some examples, right? So if you have a savings account right now with your bank, it probably offers you 0.1%, right? If I take this number, divide by 72, it would take 720 years for your money to double, right? And let's talk about putting your money into a good bond, right? Which gives you 4%. This will be, oops, can't do my math, 18 years. Okay? And lastly, let's talk about 8%. 9 years. Okay. So with the Rule 72, it's very important to understand this because basically you are utilizing time, right? Time on your side, right? So if you invest money early, you're gonna be making more money, and now I'll show you how. Say we all started off at age 30, okay? And we had 10,000 in our account. And let's do with their savings account first, okay? It's gonna take you 720 years. So you will be 750 years old for your money to double to 20,000, right? So definitely you'll be dead by then. So this is not a good investment, right? So the next one is, say you start at 30 years old, right? And your money is gonna double every 18 years. Right, so let me do this calculation really quick. So at 48, you will make 20,000. And at 66, you will make 40,000. And then let's do one more, 84. So it's not bad, right? Your initial investment of 10,000, right? You don't have to put any more money. And with 4% interest, right? By the time you're 84, you have your 80,000, right? But in terms of retirement age, 66, right, will probably be your retirement age. So this is probably when you want to withdraw. So you have about 40,000. And now let's look at 8%. Okay, you start at age 30, right? And like I mentioned earlier, your money is going to double every 9 years. So you're looking at 39, 48, 57, 66, let's do one more, 75. Okay, so your money is going to double to 20,000, 40,000, 80,000, 160,000. Okay, so I'm just going to highlight this, okay? So this one, you're dead at 6, well, you won't make your money. But in order for your money to double, you'd be dead by then. So I'm just gonna cross this out. This is a bad investment, right? So basically, what you want to learn from this Rule 72 is, if you start investing early on, right, you can definitely make a lot more money with the higher interest rate, right? So if you had a choice, right, you want to invest something with high interest rate, right? We have products out there that gives you about 8 to 10%, right? So to give you an idea that if you start investing early, right, this is the kind of money that you have. Or rather, you invest in something that only earns you 3 to 4%, right? You're looking at $120,000 difference, right? The next financial concept I want to share with you is called the X-curve. Okay, this is your responsibility line. This is your wealth line. Okay, this is you right here. This is you. This is your wife, your little kids, right? You have a house. You have a car, right? So we have a product out there, right, that will protect you, which is life insurance, right? If something were to happen to you today, right, basically your life insurance will cover the costs to help pay for the mortgage, pay for the loans of the car, pay for your children's education, right? So your family will live the similar lifestyle they have right now. Imagine you don't have life insurance, right? And you're the breadwinner for the family. Your wife will eventually have to sell the house. Your kids may not go to the college that they wish to go, right? You'll have to repossess your car because you can't, pay for the car. They have to downgrade. So basically, their lifestyle will be downgraded, right? And of course, you don't want that, right? But what if nothing happens to you, right? We have products out there, right? The same product that can give you the wealth when you are ready to retire. Okay? So within this X curve, right, there are 4 holes that everyone needs to go through. Number 1 is inflation, right? As you may know, right, or may not know, the inflation rate right now is between 3 to 4%, right? So what does that mean? It means that if you put your money into a bank, right, your $100 by next year it's only worth $97. So putting your money into something, right, that is 3 or 4% or less is not a good investment for you, right? You need to find something else that can produce more than 3 to 4%. The next thing is taxes, right? Everyone needs to pay taxes, right? But there's product out there that can show you how to limit paying your taxes. Okay. Third thing is risk. People with 401k, even if they invest in something pretty safe, right? Imagine you are ready to retire, right? And back in 2001 or 2008, right? You had 600,000, right? And you feel very comfortable retiring, and the market just crashed. Your 600,000 overnight become 400, 300,000, right? Just imagine, how long do you have time now, right? To make up that amount of money? Most likely not, right? So risk is a very big factor, especially when it comes to your retirement, right? And the last thing is health. Health is something that you cannot get away, right? As we grow older, right? I'm close to my 40s now, but once I reach, to my mid 40s and 50s, my health is going to deteriorate, right? My body is going to start aching more. It's going to take longer for me to recover, those kind of stuff. So just imagine, right? Everyone will grow old, and the health will deteriorate. So this are the 4 holes that everyone will have to go through. But what if I can tell you, I can plug these 4 holes up, right? We have a product out there that can help plug these 4 holes up. Would you be interested in learning more? Of course, right? So now this leads to my presentation on the product, okay? We have something called FFIUL, right? It stands for Financial Foundation Index Universal Life. Okay, there are 7 benefits to this product, right? And I'm going to kind of refer back to the 4 holes so you can kind of see it. So pretty much it is a life insurance policy, right? I'm just going to give you some examples so you can see. So it's going to offer you a death benefit, 500,000. Right, I'm just going to throw out some numbers so you have an idea. This 500,000 is something were to happen to me, right? My family or my beneficiary will receive this 500,000 to pay for the mortgage, right? To pay for the car bills, to pay for any loans that I have. So this way, they don't have to stress out or have to sell the house, right? So I'm basically protecting my family, right? But the great thing about FFIUL, right, versus traditional insurance is that it provides living benefits, right? Something called cash value, and then also some other addition. So before I continue on, just let me give you a comparison of what traditional insurance is versus the new type of insurance we have, right? So if you can compare a old rotary phone, right, back then, right, basically all you do is can make phone calls. You can't do anything else. But nowadays, right, you have your smartphone, right? You can make your phone calls, right, like you do, right? But at the same time, you can surf the net, you can send texts, you can play games, you can take pictures, you can do all sorts of things, right? So that's how insurance have evolved from back then. So if people ask you, I don't want to buy insurance, well, tell them, right? Educate them a little more that there are a lot more features out there. So now I'm gonna go over the features, right? And this is the living benefits while you're still alive. So this FFIUL, right? I'm just gonna give an example. I'm paying $300 a month, right? Basically, I'm saving $10 a day, right? 30 to 40%, right? Goes and pays for my insurance, right? plus fees, right? The remaining goes to my cash value. This cash value does several things, right? It earns 8 to 10% a year, right? And I'll go over how I get the 8 to 10%, right? Third thing is that it's tax-free. Remember earlier I mentioned about the 3 buckets? This is a life insurance policy, right? So your cash value that you earn, right? Not only from the yearly interest or the monthly interest, right? But when you withdraw, it's all tax-free, right? And how is that possible? So what the IRS did was they offered something called the 7702A, right? The IRC, and you can look this up on the IRS website, right? Basically, it's a perk that the IRS give to people who have insurance policy, right? Where they can earn their money tax-free, and when they withdraw, it's something called a loan concept, right? So what would happen is, like for right now, right? If you were to borrow money for a loan for your house or for your car, right? You don't pay interest off of that. So it's very, very similar, right? So what will happen is, when you accrue money into your cash value account, right? The company will give you a loan for it, right? So what they'll do is they'll give you a 2.75, right? So the first 1 to 10 years, right? They will charge you 2.75%, right? And at the end of the year, they credit you back 2%. So you will be paying 0.75% on your loan if you wish to decide to withdraw year 1 to 10. But any years 11 after, they will charge you 2%, right? And they will credit it back 2%. And basically, it's there's no fees at all, right? Because they will credit back you at the end of the year. So that's how it works, right? They will loan you your own money. So that's how they get around not paying taxes. And this is completely legal. Like I mentioned, you can go to the IRS website and you can learn all this stuff. Where's my eraser? So number 4, right, is the risk. I'll call it risk-free, right? Basically, this is downside protection. Okay, what does downside protection means? It means that if you have funds in your account, right, and if the market goes completely bad, right, this company guarantees 0.75%, right, and they will cap you at 15%. So after the 2008 market crash, right, they decided to have this product out there, right, so to help people who are ready for retirement to not lose their money again, right? So it came out with a guarantee that you will never lose your principal, and at the same time, right, they do give you a cap, right? So there are years that it's gonna exceed 15%, right? So I'm just gonna throw out some numbers, but say it's 23%, right? They will keep the 6%, 23%, they keep the 8%, right? In case when there are bad years, to guarantee 0.75%. Number 5 is flexibility. What that means is that my monthly premium, right, is $300, right? I have the opportunity, right, if I want to do more investment into my cash value account, I can put up to 3 to 4 times this amount, right? So I can grow my money a lot faster, and I can grow my money more. By the time I'm ready to use the money for whatever reason or retirement, I can withdraw without paying taxes. So I have the flexibility to pay more. At the same time, right, say I'm not doing well in my job, or I got laid off or something like that, right? I can call them up and say, hey, I'm not doing well financially right now. I just lost my job. I want to reduce my monthly payment. You can call in, and then they'll tell you how much. Basically, I'm paying only 30 to 40% of this amount just to keep my policy alive, right? And also a great thing is, say that I had 10,000 or 20,000 in my account and I can't afford to pay anything. You can call them up and say, hey, for the next few months, go ahead and just pull the money directly from my cash value account to pay for my insurance to keep the policy alive. So definitely you have that flexibility. Oh, and one other thing which I think is very, very important is that you have the flexibility to withdraw as long as you have cash value. So other retirement plans, right, such as the Roth IRA or the 401k, right, you can take loans against it, right, but then you have to pay back. But when you do withdraw, right, there's a huge penalty if you withdraw before the age of 59 and a half, right? So there is no restriction with our product here. Number 6 is terminal illness. What terminal illness is, if I go to a doctor, right, and the doctor gives me a note and says, hey, Tone, you have liver cancer and you have only 12 months to live, right? I take this letter, right, and show it to the company and say, hey, you know what, I have terminal illness. I basically qualify for this terminal illness. This gives me 75% of my death benefit, which is about $375,000, right? I can use this money whichever way I want, right? I can finish my bucket wish list. I can go to Asia, get a new liver for transplant. I can donate my money to charity. I can give to my family. I know exactly what I can do for with this money, right? And once I do pass away, my beneficiary receive the 25% plus whatever cash value I have in my account, right? So that's a great benefit. You know where your money is exactly going to. And last, number 7, this is probably the best product out there. Unfortunately, not everyone will qualify, but if you definitely qualify for this, this is the reason why you want to get this product. Okay, it's something called long-term care. There are 6 daily activities that you do every day, right? Mobility, to eat, to shower, to wear clothes, to use the restroom, to hold your bladder, right? If 2 out of 6 you cannot perform, you qualify for something called long-term care, right? Basically, it's 2% of whatever your death benefit is. So in this case, right, it is equivalent to $10,000 a month. A lot of people think that long-term care is for the senior, for the elderly, but just imagine, right? You get into a car accident, right, and you end up being paralyzed. You cannot perform 2 out of the 6. You actually qualify for long-term care, right? So instead of having my wife or having my children take care of me, showering me, wiping my behind when I use the restroom, that kind of stuff, I can hire someone to take care of me, right? I don't have to stress out about my wife having not going to work and making money, right? Now I have the funds, right, to use to pay for someone to take care of me, right? So definitely the cost of long-term care is very, very expensive, right? So having this option really gives you peace of mind, right? If something were to happen to me. And a fact that you need to know is that 70% of age 65 or older requires some type of long-term care. So that tells me that 7 out of 10 people at age 65 will need this, right? So definitely having this, right, will give me peace of mind that I do have something out there that can help me out financially when I'm in this position. So just going back to the X curve, right? The first thing is inflation, right? Because this product earns 8 to 10%, right? It plugs the inflation hole, right? And also this product is tax-free, right? This is basically money after paying your taxes. So all your earnings and when the withdrawal happens, it's all tax-free. So this covers the tax for one of the second hole. The third hole is risk, right? Like I mentioned earlier, this is risk-free, right? Your principal, your money you have in this account, right, is pretty much safe, right? There is downside protection. So in terms of calling this investment, it's not really investment. It's called a savings account, right? That can guarantee you 0.75% and gives you as high as 15%, which is awesome. You know, what out there can give you 15%, right? And the last thing is the health, right? We basically cover the terminal illness, right? If something were to happen to you, you have that 375,000 to use, right? And also the long-term care that I mentioned to you. 70% of the people who are 65 years old does require long-term care. So the odds of you needing this later on in your life is very, very high, right? So right now, right, while you're still young, you still can qualify for this, right? Right? I say, you know, you definitely should take a look at this product, right? So now let's go over the company that provides this product. So we are Transamerica, and for you who don't know who Transamerica is, if you go to San Francisco and you go to Chinatown, you see that tall building, that pyramid building, that's Transamerica. So the parent company of Transamerica is Aegon, right? Aegon is located in the Netherlands. They have about over $500 billion, right, in assets, right? So definitely they wanted a footprint in North America or in the United States. So they went ahead and purchased Transamerica. And for us, right, we are World Financial Group, right? Transamerica needed a marketing arm, so they went ahead and purchased us, right? So we're World Financial Group. And what we do for families is we help families save, right? We offer protection, which is life insurance, and then also we help people with their retirement, right? And the great thing about World Financial Group is that we're not tied into just Transamerica products, right? We offer over 200 different products out there, right? Let me give you some names like Prudential's, Nationwide, MetLife, you know, those big names. We only offer A-rated companies, and if companies that fall out of the A-rated, we no longer use them. So that's how stringent our policy is in terms of what companies we offer. Okay, so what we do, we help people with cash flow, right? We can help people with the business. They can become